Hey out there, all you cool cats and kittens, coming to you for another one. Our lesson today does not make sense for me to do an introduction with words. We're going to have to bust out the old G-guitar here. So without further ado. Wherever you're driving, wherever you're bound, on freeways and byways, the whole country round, you'll feel better knowing anytime, anywhere, that like a good neighbor, State Farm is there. You never forget it. Never forget it. State Farm is there. This message brought to you by Allstate. I mean, whatever. Okay, here we go. Going on. We're talking about insurance today, class. We're going to talk about insurance. Everyone is trying to get your money. They're selling you a product. So how do you differentiate? How do you decide what to purchase? Well, I'm not going to tell you what to purchase, but I am going to explain the basics. Hopefully this is something that's helpful for you. And yeah, I used to live in a State Farm building. They were okay neighbors. Yeah. Anyways, one thing to mention, Aflac is kind of its own. I do not have Aflac. It's kind of its own breed. It's not really insurance. It's kind of like you sign up for this plan, and then if you can't work, they just pay you. So it's this weird, or you get hurt or something, they'll just pay you like a check. It's not. You kind of have to pay for things up front. Anyways, interesting thing. It's a different breed. All these guys are offering pretty much the same product. Most of them are, though, for the most part. It's important to note that none of these companies are offering health insurance, though, right? They're not offering health insurance. They fall into a different category. Insurance is very, very heavily regulated. And so, oh man. Anyways, let's go ahead and get started. What are the kinds? So what is insurance? Insurance is just a safety net. And I'm gonna go over a lot of things that are, scary and uncomfortable to talk about today. But one thing to keep in mind is all insurances, if you were to just explain it, it's designed to make sure that you don't go into crippling debt. If you've been saving money and do everything right your whole life, you shouldn't, if something bad happens to you, you shouldn't necessarily have all that taken away from you. So if you are properly insured, you can hopefully prevent that. And so we're going to go over the main categories of prevention so you don't lose all of your assets. So lots of people pitch in. So imagine there's this giant big pot. Everybody is throwing in money into this big pot, and you may never get hurt, and all your money is going to go to someone else. And you got to be okay with that, right? You're putting money into a pot, but then if something bad happens to you, that big pot is available for you to get some coverage. And it's all about looking at making sure that you're going to be okay and your family is going to be okay. So it's designed to keep you out of debt, and it's a group effort. There's a lot of people involved. We're going to kind of go over who those different entities are. Let's talk about the kinds of insurance first. The big ones, or the ones that most of you will probably all have at some point in your life, maybe, hopefully. Health insurance used to be required that you have it under the Obama administration, and that is no longer the case. Auto, big deal. Life insurance, so you got to cover your like medical bills. This covers accidents with your car. Life is something separate, kind of in the event of your death, should just call it death insurance, I suppose. And then your home. So, but that's not it. You can really insure anything of value. This is a professional lacrosse player who insured his mustache for, I think it was like 225 quid 25,000 quid. So if something happened to his mustache, then he could make a claim on his insurance policy if someone did a drive-by snipping or something. And you know, I'm a big Magic the Gathering player. I enjoy playing the game, and there's some people that I've met that have collections that are so astronomical that they have them insured. So if their house was to go up in flame, you know, they have, or the place where they were storing it was to go up in flame, they have those items insured, and they can get the value of those items back. They have not lost, but they have to pay a price for that. So they are insuring, you know, that they get the things that they need, basically. And it comes at a cost. It's a product. It's something that you purchase, and you kind of pay a membership for. Those are the four main categories. So here's the deal. This is the main point. Insurance is all based on statistical risk assessment. The riskier you live, the more expensive the insurance products are going to be. Plain and simple. If you can live at a less risky, or rather, if you can be less risky on the regular, then you are going to pay less in insurance. And in fact, it can be very, very manageable. So it's all about risk, assessing risk. And there are many ways that we bring risk into our lives that we don't really realize. Yeah, so let's see. Let's do health insurance first. We're cruising right along. We're making great progress. Wow, guys, this is fantastic. Health insurance first. A lot to cover here. First thing, what's a premium? Okay, a premium is your monthly, basically what you are pitching in monthly to the big pot. What is going to your insurance company? So that's what we're going to write down. Let me get my pen ready here. I can make sure my ink is selected. Sorry for the delay. Oh my gosh. I'm burning internet time. What would Salcon think of me right now? Oh my gosh. Here we go. Yeah. So what's a premium? A premium is really not just you, but it's what gets paid every month. And you might get a pay stub like this, and it says, hey, here's your premium. It's $335. You're going to throw, or we are throwing $335.72 together. Okay, so the company, usually it ties into where you're working, so your employer will help pay for your costs. So the company or the employer is paying $230.77 into the insurance to make sure that you can get medical coverage. The employee is paying $104.95, and yeah, it's the monthly payment. So this is what you and your employer, sometimes it's and or your employer, and your employer pay the insurance company every month to make sure that you are cared for. That's a premium. And there are premiums and all kinds of insurance that you have to pay. It's basically the money that is guaranteed to come out of your wallet. Premium is money that is coming out of your wallet no matter what. Okay, I think we got that. So here's the big deal. When you're looking at health insurance and you're looking at health insurance plans, there's a couple things that you need to take into account. You need to look at premiums. You also need to look at a couple other aspects of that plan, many aspects. This insurance is, you can get down to a level of complexity that is unbelievable. So it can get very, very complex very, very fast. But I'm going to try and make it as simple as possible. So what's a deductible? You need to consider on a plan, you need to consider the premium, because that's what you're going to have to pay every month, but you also need to consider the deductible. So what the deductible is it is the amount of money. This is the amount of money you pay the hospital, I guess the hospital or providers Okay, when I say providers, and when you see providers on any insurance language, provider really means doctor. It doesn't just mean doctor. It means doctor or physician's assistant or dentist or whatever. Whoever is providing healthcare. So, okay, so it's the amount of money you pay the provider in a year before the insurance starts helping you pay your bills, I'll say medical bills. I'll be specific here for health insurance. That's a lot. That's a lot of words. Okay, the amount of money that you pay the provider in a year before the insurance starts helping you pay your medical bills. That looks like an N, and I apologize. Okay? So there's a lot of key words there. So key word here being helping you. Your deductible, so basically, this is how the deductible works. When you sign up for a plan, you're saying, all right, you're gambling. It's a risk assessment, right? What can I be comfortable paying if something really, really bad happens to me? Health insurance is very, very, very expensive, and it can be. And I know people that have, had people in their family go through things that cost, $300,000 worth of medical bills. My dad delivered babies for a long time. He was an OB nurse, not under the table or anything, but he told stories of people that had twins, premature, had to get medevac. Medical bills were upwards of $200,000 for a delivery, right? That's incredible. That is a lot of money. So what is the amount that you are comfortable paying out of pocket? That's kind of where the deductible comes into play, kind of, because it's how much you have to pay before the insurance starts helping pay your medical bills. They don't pay for everything after you hit your deductible. So let's say you have a $5,000 deductible, which is pretty high. Okay, let's say you rack up, let's say $6,000 worth of medical bills. You hit your deductible when you paid your 5,000th dollar, and that extra $1,000 that is above 5,000 is now your insurance is going to help you pay that $1,000, but they're not helping you on the previous 5,000. And we'll go over to some more language there, but this is the number that you have to pay before they start helping. Now, plans can get pretty complicated because on a medical plan, each individual has a deductible usually, and for a family, there's also a family deductible, and we'll get into the differences between that. So it says, with family deductible, coverage begins for each individual member as soon as his or her individual deductible is met. So check this out. If you have $5,000 deductible, let's say my family, me, my wife, and my kid, we each have $5,000 deductibles, that's ridiculously high, but if we each have those deductibles, and I rack up $5,000 of bills, okay, or of medical bills, and then I go and break my arm and I have to go back to the hospital, well, the bills for my arm break are now going to be covered because I, as one member, met my deductible. I reached the amount that was required. However, if my wife were to go and break her arm after I had met my deductible, she would have to still build up to her. So we'd still have to pay if my wife got hurt, up until the total amount that our household has paid has met our family deductible. So hope that makes sense. So let's say we have $5,000 each, but a $10,000 family deductible, right? So I rack up $5,000 worth of medical bills, and then let's say my wife, we had a kid or something and racked up another $7,000 worth of medical bills from the delivery. Okay, so and So what would happen there, depending on whether or not the insurance will cover part of a delivery, but what's going to happen there is of the 7,000, the 5,000 from will go towards my wife's deductible, and we will have hit our maximum family spending amount there, and anything in excess of that for our family is going to be helped, or the insurance company will help. Okay, so once the family deductible is met, everyone in the family is covered, even if their individual deductibles are not met. So that means like we've met our family deductible, Oscar then gets injured, and he has $10,000 worth of medical bills. Even though Oscar hasn't met his deductible, the bills from me and my wife, they did add up to our family deductible, and so all of that from Oscar's injury would be covered. Hopefully that makes sense. So again, the amount of money you pay doctors and hospitals before the insurance starts helping you pay. Okay, and then there's this thing called the out-of-pocket maximum. And what this means, what this means is basically plans have an out-of-pocket maximum, and they have deductibles and they have premiums. You won't pay. You're kind of guaranteed you won't pay more than this amount. So an out-of-pocket maximum is always going to be higher than a deductible. So the key word here and how they're an out-of-pocket sounds to me like it sounds similar to a deductible, but it's not. Because a deductible, when you hit your deductible, that's when the insurance starts helping, but you're still paying for a portion of the bills after you've hit your deductible in most plans. And so you won't have to stop paying medical bills until you reach, or portions of the medical bills until you reach this out-of-pocket maximum. That's what that is. So we have premium, which is your monthly payment. We have deductible, which is the amount of money you pay the hospitals before the insurance starts helping. You have out-of-pocket maximum, which is like the absolute maximum that you're going to pay in a year for medical bills. You also have these two things called copay and coinsurance. So once you meet your deductible, once you have met your deductible, each time you go into the hospital, sometimes you'll have something called a copay. And what a copay is it's just like it is a fixed amount you'll pay with each doctor's visit. So you got to be careful on when you're looking at insurance policies. If you go in and so you met your deductible and you go into the doctor, you may just have a copay, and sometimes there are copays I think before you met your deductible, but it's just a fixed amount when you go to see the doctor. So what's coinsurance? Coinsurance is usually after you've hit your deductible. It is a percent. Oh boy, I lost my pen. Hold on. It is a percent of the bill. So how is this coinsurance different from copay? Well, coinsurance is going to scale. So it's going to change in its amount depending on the size of the bills after you've met your deductible. So if you have like a 10% coinsurance and you rack up, you get a $500 bill from the doctor, then if you have 10% coinsurance, you're going to pay an extra $50. So you just pay $50 and then you're good, okay? And then a copay is a flat rate. So it's going to be like, hey, every time you go into the emergency room or every time you go into the clinic to get checked, it's $150, no matter what happens there, okay? And the reason I'm talking about already hitting the deductible, the reason I have this down here is because, remember, there's two deductibles. You have your family deductible and your individual deductible. So after you meet your individual deductible, you'll probably start paying copay or coinsurance, and a lot of the time. And then the money that you are paying in coinsurance is going towards your family deductible. Okay, in summary, medical plans with low premiums. So if you have low monthly payments, tend to have higher deductibles. Okay, so if you have if you're paying less a month, you're giving the insurance company less money. So basically, they're gonna cover you less. They're saying, hey, you're taking a little more risk, which means you're probably pretty healthy, and so we're going to make sure that we're not going to cover you as much, which means you have to pay more to the hospital before we start helping you, and higher out-of-pocket maximums. Medical plans with high premiums, so if you're paying a lot every month, tend to have lower deductibles. Okay. So if you're paying a lot every month, they're like, hey, wow, you're giving us lots of money, so we are going to help you. We are going to be able to pay more of your bills, or a larger percentage of your bills. I think that kind of makes sense. All right, let's keep going. A couple more things here. Let's take a look at this problem real fast. All right, so a woman is pregnant and her medical plan has $3,000 individual deductibles and a $10,000 family deductible. The mother gives birth and the hospital fees are $8,000 for her. There were a few complications with the birth and the child has to stay in the hospital for a few days. You're thinking, hey, mother and child, they came in as one unit. Isn't that just one deductible? Nope. As soon as the baby's born, if that baby has complications, that baby must meet its deductible, assuming you filled out the appropriate paperwork. There were a few complications with the birth, and the child has to stay in the hospital for a few days. That adds up to an additional $12,000. Okay, once any deductible is met, you pay a 15% coinsurance, which is probably ridiculously high. I just made that number up. About how much does this delivery cost the family? Not how much does it cost total, because cost total is just adding these two numbers is $20,000. About how much does this delivery cost the family? All right, so let's think about the mother first. So the mother is paying $3,000. I'm going to draw a little chart here. So we got the mom. Mom is paying $3,000 for her deductible. Almost there. Okay, mom pays $3,000. Okay, now how much is left of her bills? After the $3,000, we have another $5,000. So on that $5,000, since she's met her deductible, she does not have to pay the full $5,000. She only has to pay 15% of that. So the mom is going to pay plus 0.15. 15% is a decimal times the 5,000 that's left. And this is kind of ballparking. It's not as cut and dry as this when you're doing insurance. Okay. Okay, so that's an extra $750, which means she is going to pay $3,750. Let's assume that happens first. Now let's take a look at the child. Okay, so how much is left on their family deductible? How much is left on their family deductible? Well, they have a $10,000 deductible. 10,000 minus 3,750 is 6,250. So 6,250 are left. So for the child, when the child goes to pay, the child is going to pay their deductible, which is the child is going to pay their deductible, which is $3,000 as well. So the child bills are gonna pay $3,000. The deductible has been met. So now we're at 6,750. $3,250. So the family has paid $3,000, and I guess the child's deductible has been met already. So then they're just going to pay 15% on that anyway. So that's 0.15 times whatever is left, which is $9,000. Now this would be a little bit more complicated. It would be a little more complicated if the family deductible got met prior to the child's deductible getting met, but that's okay. 3,000 plus 0.15 times 9,000. The child's medical bills, they are paying. Oh, look at that. So if you take a look, and we add these together, that's 3,750 plus 4,350 gets a total of $8,100 roughly. So they have not met their family deductible yet. So their coinsurance, what they were paying before, still went into their family deductible. So if, let's say, if they had another kid get injured later, they would only have to pay whatever's left here before their family deductible is met. They wouldn't have to meet the $3,000 for their other family member. Okay, so that's kind of how it works. So about how much does this cost? I say about. It's not quite this simple, but it's kind of close to this. Let's keep moving. There's a good little note here. So there are a bunch of little kind of stipulations as to where you can go be seen. If you are hurt, certain hospitals and providers are not going to be recommended, or based on your company's insurance may not be covered. So what that means is you could walk up to the door and say, I broke my arm. Then you walk in and then they help you. You get taken care of. You go home. You get the bill in the mail, and the insurance says we're not covering it. There's not going to be like a red flag. Hopefully, the receptionist is like, "Hey, we don't take your insurance here." When you walk in, that would be great. But you may get charged for a place that wasn't covered because it wasn't a preferred provider. So it is the provider network is something that comes along with an insurance plan, and I wish it were more simple. It's not. Provider, again, is just the doctor, right? This is a list of approved doctors, PAs, physician's assistant, ... right? A bunch of dentists, whatever. A bunch of people that are okay. So why does that exist? Why is there a provider network? Well, maybe there are certain less reputable providers that are trying to leech off the healthcare system, and so they don't want you to be able to go to those people and waste the insurance company's money, okay? And you like soothsayers or something going on. I got to make an appointment with my soothsayer. I almost forgot. That reminds me. Okay. When will your medical expenses not be covered? So here's the deal. In 2017, hospital costs average this per day for a person to stay in the hospital. And if you were going to stay at a hospital for an extended period of time, averaged $15,734. So when do you have to pay when you go to see the doctor? And you're going to pay if you haven't met your deductible. You're going to pay if the procedures that you're having are not something that your plan covers. Like if I want to go get a facelift, that's probably not something that my plan is going to cover. It's a medical procedure, but it's not not super necessary. Or maybe you're a hardcore skateboarder and you want to get a knee replacement. Maybe your insurance is not going to cover that because it's something that you brought upon yourself. So it's non-necessary or whatever. Or a pre-existing condition, or there's all these weird things that can cause you to not be covered. And these aren't the only ones, right? There are like things like pre-existing conditions, like you get insurance after you got injured and expect to get covered. It's not risk. You already had the thing happen, right? So the other thing is you visit a provider outside your network. If you go to the soothsayer doctor, your insurance bills aren't going to get covered by the insurance company. And this can cost you a lot of money if you don't know these things. So make sure you check and do your research. I know it's painful and it takes time, and no one's going to pay you to do it, but you're paying yourself if you take the time to invest in doing that. All right, so what happens when you get a bill? So here, let's run through the flow chart of what happens, and this gets a little funky. But the first thing is very obvious. You get sick, you go to the doctor, okay? You go to the doctor, and then what happens is when you walk in the doctor's office, they're going to say, hey, do you have your insurance on you? You're going to give them your insurance. I'm actually not sure what happens if you don't have that with you. In a lot of cases, it might vary. You go to the doctor, and then you're going to give your insurance info to the doctor. Give insurance info to the doctor. Okay. So in this step, you go to the doctor, they heal you or whatever, right? They help you get better. When you give the insurance to the doctor, then what happens is they figure out how much that's going to cost, and they take that amount and they send the bill to your primary insurance. Primary means the first one that's going to happen, okay? And the primary insurance is going to go, okay, yeah, we'll cover this, and so we're going to make sure that this gets covered. And then once they have paid for something, the remainder of the bill gets sent to your secondary insurance. So you can be covered. Like, for example, if actually we're double covered now because we both work for the school district, but maybe some, like my wife went and got a job somewhere else for one of the unions or something, and she got family coverage, then my insurance would be covering her and me, and she would put down my insurance as her secondary insurance and her insurance as her primary insurance. And you can actually have more than that. So you can have additional types of insurance, primary, secondary. The third one would be tertiary. Okay? So what happens is they tell you how much that they billed, and then the insurance mails out what's called an EOB. So the EOB explains how much they are going to cover, it's how much they are going to cover and how much is kind of left to you. It's listed there. And so then what happens, it's kind of a plan. It stands for explanation of benefits. The secondary is going to do the same. Tertiary is going to do the same, right? So you get all these arrows coming up saying what's going on. They pay the insurance, rather. This kind of happens beforehand. The insurance pays the doctor or hospital, or they don't pay. Okay, and then what happens later, so they send out an EOB, and this says like, hey, this is what is going to be your responsibility, explanation of benefits. This is what was covered, okay? And this is not a bill. So you're going to get a couple things from the hospital. You might get three. I usually get like 3 or 4 things. I get an EOB that says, hey, this is what we're going to cover. The insurance pays or doesn't pay. And then I get a bill from the hospital that says, hey, things are being processed. This is what you're likely to pay, or this is what the outstanding balance is. And then I'll get one later that says, hey, this is how much the insurance pay. This is how much you have left over. So you end up getting the remainder of the bill. Okay, you'll get what's left over, and then you have to pay that back to the hospital. That's what happens. I was never told this as a young adult. I didn't know what an explanation of benefits was. I was pretty confused as to how to process this or how this whole process happened. I think that there might be, I think Monsters Inc. ended upstairs. Apologize for that. All right, moving on. Let's keep going. Medicare, Medicaid. What are these? This is something that you pay for. This is on our federal taxes. So it's a federal program that provides health coverage if you're 65 and older and or have a severe disability, no matter your income. It only covers what is medically necessary. Basically, this is insurance that you get by the time when you hit 65. So we all get it. It's it's a good thing for us to have. Some might argue otherwise. So then what is Medicaid and what's the difference? Medicaid is a state and federal program that provides you health coverage if you have a low income, or there's a bunch of other things like maybe someone is in transition and isn't really living with their normal family or something. They might qualify for getting covered by Medicaid. So it's basically people that are on their own or have a low income can get covered through Medicaid. So this is low income, this is old people, basically. Okay, that's it for health insurance. That was a lot. We're going to move on to auto insurance next. You are required by law. It is illegal to not have auto insurance. This is something that you have to have, and it just boggles my mind that there are many, many kids that go through high school and don't know about this. So what kind of insurance are you required to have? Because there are many, many kinds of insurance that an insurance salesman will talk to you about and tell you about and maybe try to sell you, maybe just explain to you if they're a good insurance agent. The one that you are required to have is liability insurance. Okay, now let's watch that. I like watching this a couple times and then focusing on a different person each time. Is that kind of sick of me? I'm sorry. Liability insurance helps pay for damage to other people and other people's property. Here's a better explanation. So it covers other people's property that you damage, property being like their car or maybe their fence or something like that. It covers medical costs, funeral costs, low income, pain and suffering for people that maybe you hit somebody like this guy, maybe the guy in the red hat that got slammed against the candy stand. Maybe he got a lower back injury and he's unable to work at his job and you have to pay for his income. Liability is very, 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 very important to have because the damage that you can cause other people can be way more than the cost of your car. Or, it doesn't cover you, it covers other people. It can also cover a defense if you are sued after an auto accident. So in that case, it does cover you. It does not cover damage to your own property, your own medical costs, or claims in excess of your coverage limits. So what this means is like when you go to buy liability insurance, you have to buy a dollar amount. So you have to say, all right, I want my insurance policy to cover this much or X amount, right? Well, how much is that? It's this. So this is a different one. The state of Alaska, it depends on what state you're in, requires a minimum of $50,000 of bodily injury in liability per person. So a person in the other car or a person on the street that you accidentally hit. $100,000 in bodily injury liability per accident total. Okay. So if there were 3 people in the car and they all had really, really bad injuries, you're capping at 100. That's the most that the insurance company is going to pay out. And $25,000 in property damage liability per accident. That is the minimum that you want. And I think I have an awful lot more for liability. I don't think it's terribly expensive to increase liability a lot. I think it's a good thing to have. But the other kind of insurance, another kind of insurance, we're going to go over a couple of kinds that you can get is called uninsured, underinsured insurance. You're saying, what? What does that mean? It's saying the people that you get in an accident. What if someone hits you and they don't have liability insurance? Think about that for a sec. You're doing everything right on the road, right? You get hit by somebody else. You can see why the state requires you to have liability Because if you get hit by somebody else and you've done everything that you were supposed to do, you were following the law, then the other person's insurance, their liability insurance, should cover and fix your car if you were doing nothing wrong. However, no one is checking up on people and forcing them and saying, hey, you have liability insurance? Hey, do you have liability insurance? No, there are people out there that are driving around on the road that are not insured, or the amount that they are insured for is not up to what the state recommends, and it's not enough to fix your car. Or maybe it's not enough to fix your back if you get hit by them, right? So hopefully their insurance is going to cover that. So what uninsured or underinsured insurance is you're assessing the risk of what if the situation where you're doing everything right and you get hit by somebody else and they don't have insurance. You have purchased insurance for yourself for that specific scenario, and your policy will cover you in that scenario. Not them, it'll cover you. So what happens if you say, I don't have my insurance card info on me? Well, you can get in trouble, right? You can if you don't give your insurance information to the police or whoever is there at the scene at the accident, you're required to call the police if you get into an accident. If you don't have your insurance on me, like, you can have your car impounded, it can get ugly, right? So you are required to have a copy of your insurance card on you at all times. Now, there are options. You can have it digital, you can have it on your phone, but you need to be able to show your policy to the other person exchanging insurance information. You need to be able to show your policy to the police when they show up. Okay, so we've covered liability, you're covering damage to other people. We've covered uninsured, underinsured, which protects you from someone if they hit you. Now, if you don't have uninsured, underinsured insurance, if you have not purchased this for yourself and you get hit and your car is destroyed by someone that doesn't have insurance, you are out of luck. You got to pay for the car, right? I think the phrase is, you can't bleed a turnip, right? So if they don't have anything to pay, they're not gonna pay up, right? So that kind of sucks. So you want to make sure if that's something you're worried about. And this is also not too expensive to purchase because it's slightly rare for that to happen. Okay, the one that when you go to buy insurance, you think would be the one that you would be required to have. You're not actually required to have this. Collision. Collision helps repair your car if you run into something. So collision is only you run into another car, it repairs your car. I do not have collision on my car because my car is a piece of crap. It's not a piece of crap. I love it very much. It's got me a lot of places. I'm very thankful for my car, but it's not worth anything. The Kelley Blue Book value of my car is like $300. There's no, I'm going to pay for that in collision insurance in like a month, okay, or a couple months. There's no sense in me paying for someone to replace my car that's worth $300. It's not worth it. I can just, go get another $300 car or whatever. I don't know. Go get something that's a little more reliable. So if you have an old car, maybe you don't get collision. I'm not saying you shouldn't, but like if you have a brand new car, you probably want to get collision because if you get into an accident, so even if you're the one that caused the accident, the collision will cover your car. Now, one thing, let me make sure I covered everything here. In uninsured, yeah. So does it matter if you are, if this is your fault, right? Liability. So hopefully that guy that had liability insurance, because his policy is going to have to cover all the damage to the store and any damage to the health of those people. Yeah, we went over that. Okay. And then collision, even if it's your fault, it will repair your vehicle here. People make mistakes. We're human beings, right? Yeah. All right, so that's collision. The fourth kind is called comprehensive. All of these accidents that you see here would not be covered by collision because you did not collide with another vehicle. This one was a falling object, a tree. This one is a moose hit, and this one is hail, damage from hail. So it basically comprehensive helps to cover everything that isn't collision with another vehicle, theft, vandalism, hail, fire, falling objects, natural disasters, floods, all that stuff. If you have collision, then you can get your car replaced under those circumstances. So when you see like those videos of the floods and wiping out all these vehicles, those people have collision. They're probably in good shape. If they don't, they're going to have to cover the cost of their car to replace it themselves. Yeah. So it just depends on how new your car is and how much risk you are comfortable with taking. You can get a brand new car and not pay comprehensive and not pay collision, but if you get in a wreck, the liability insurance may cover your car. They may not have it. It's up to you. Okay. Life insurance. Moving on. What is life insurance? Life insurance kind of replaces an income. So if you die, it's meant to pay those that are reliant on your income. There's a lot of things that can affect whether or not, or have a great effect on how soon you may die. And it's for a death that is accidental. If you buy a life insurance policy and you go out and do something really, really stupid and get yourself killed, then you may not be covered here. This is covers the things, and the details are crazy, but it covers things that you're not planning for. If you knew that something was going to happen and you were going to die, and the insurance company is able to prove that you weren't being completely honest, then you're not going to get your life insurance payout. So life insurance are usually large sums of money. I think the minimum policy is $200,000. So I think that's the minimum, the smallest they go. So a $200,000 policy means if you were to die, then the insurance company would pay out $200,000 to whoever the beneficiary of your policy was. Okay? Important to note, when you go in to get a life insurance policy, you want to be extremely healthy when you apply. The first couple questions that they ask you are, what do you do for a living? If you are Travis Pastrana, his life insurance is going to be astronomical because he could die on any given day. He's crazy, right? He's a motocross racer, right? You want to be really healthy when you apply, and you want to tell the truth. If Travis Pastrana were to go in there and he was like, yeah, I am an accountant. I work in a cubicle by myself all day, and then he paid for $300,000 life insurance policy, and then he died racing motocross, and then they went out to look, and they were like, you lied. You were not an accountant. You are racing motocross, and you weren't completely honest with us, so we don't have to pay out. So if you are not honest when you go in to make your policy, then you can be in deep doo-doo, okay? You might not get covered if something bad happens to you. So if you don't tell them that, well, you get the point. You also want to be healthy. You want to make sure you're staying real hydrated. First couple questions are, do you smoke? They're looking at your risk. They look at maybe previous medical history here for life insurance. Make sure you've got, if you know information that you're about to get a disease and die, then they don't want to get taken advantage of. They want to be able to cover you for the things that you can't plan for. There are many different kinds of life insurance. There's term life insurance. There's insurance that goes for extremely long term, short terms, whatever. So it can get fairly complicated, but the basic idea is this is something that is really important, especially if you have kids at home. If you pass away and then you can't take care of your kids, you want a lump sum of money to go to whoever is taking care of them and make sure they have money left over for them. So make sure you're healthy, make sure you drink lots of water, and smoking is not going to help you out. Your policy, it's all statistical risk assessment. They know that if you smoke, you're more likely to die early, and they're more likely to pay. So you pay a higher premium. You're going to pay a higher premium for life insurance. Okay, how about home insurance? The whole idea for home insurance is meant to replace your house and all the stuff in it. If you go get a home insurance policy and you have no proof of what's in your house, you're kind of in trouble. You need to make sure you need to make sure that you document the things of value in your house when you get home insurance. So my insurance agent recommended I go through and take pictures of all the things of value that we have, so that if something were to happen, then it would be covered. Okay. It can also, like, it doesn't have to be, so like if your house gets burgled, you can file a claim and get stuff replaced. If your house gets burgled, that's a problem. If your house catches on fire and burns to the ground, that's a problem, but they're going to ask you how you heat your house, to do a risk assessment. It's also meant to cover any accidents on your property. So if they say, hey, do you have a dog? They don't say what kind of dog. They'll say, hey, do you have a dog? If you have a dog, then your insurance is going to be more expensive because, you might be likely to, a dog might be likely to bite somebody, and then they can kind of, that person might be able to sue you, or if someone comes onto your property and they slip or get hurt, they could potentially sue you. Home insurance is meant to cover that. Or how about if you have a deck? So they'll ask you, do you have a deck? Do you have anything that's up high, like a second-story deck that someone can fall off of? That's the kind of thing that they're going to ask you when you check into your home insurance. It's meant to cover all sorts of accidents on your property. Home insurance policies typically don't cover every natural disaster. Like if you want tornado insurance, you're probably going to have to go buy tornado insurance. If you want flood insurance, you have to go buy flood insurance for that specific situation. All right, almost done, I swear. Okay, you can also get renter's insurance. Renter's insurance protects from things like theft, irresponsible landlords, guest medical coverage if someone gets hurt on your property, and emergency living expenses. Let's say you get kicked out because your landlord was irresponsible, or something bad happened to your apartment. If you had purchased renter's insurance, you could file a claim with them, and then they can put you up in a hotel. If you didn't, you're out of luck, and you got to go find a place to live. Okay, one thing you guys got to realize, you can't just file a claim for any old thing. Anytime you file a claim, it's like an application for reimbursement. So it's like an application for them to pay you back. And if it's a really big claim, if you file and say, hey, look, I had a rhinoceros charge through my house, and it came through and took a bunch of walls out and destroyed all my belongings. To make sure that you were honest, the insurance company is going to send out what's called a claims adjuster or an insurance adjuster. They're going to decide how much. They're going to check and make sure you're being honest and ask you a bunch of questions. And based on your claim and on the evidence they collect, they're going to basically determine how much they're going to pay you back. And depending on who they send, might change what you get back. So it's kind of like, you got to be careful of the information you say and how you appear when you're talking to a claims adjuster, or else that might determine the amount that is covered. The other big thing is when you file a claim, that tends to increase your premiums. So they're saying, hey, you just filed a claim, something bad happened on your property. Well, that means you're a pretty risky person. So now how much you have to pay every month is going to go up. So you got to be careful there. I want to remind you that insurance is supposed to help you relax. I know I went through a lot of horrible things today, but the idea is that it's supposed to be there as a safety net for you so that you don't get something horrible doesn't happen to you. Things can be expensive. Medical bills can be expensive. If you hit somebody with your car and they can't work or do their job for the rest of their life, the thing that they've been training for, they can sue you for a ton of money, and you want to make sure that you have liability insurance to cover that, right? So to make sure that you aren't left with crippling debt, or your family isn't left with crippling debt. Auto insurance, life insurance, right? Same thing. If you die, you don't want your kids at home to not have money left over. And lastly, your home insurance. You don't want your house to burn down and be left with nothing. So all of those situations can be taken care of. by simply making a call to an insurance agent and talking to them about what's best for you and your family. And you want to find an insurance agent that's going to be honest with you, that is willing to take the time to explain it to you and not trying to rush you through stuff. Okay, so that would be my, if you're going to go get insurance here in town, please call someone that is going to care about you and is willing to help you. If they don't seem like they're willing to help you, go somewhere else where you can find someone, and they're going to do that for you. All right, that's all I've got for you today. And I really appreciate you for tuning in. Got an assignment uploaded on the website. Check it out. And yeah, we'll see you guys later. Stay safe out there.